Nilkanth left behind a promising career in financial advisory with a bigger purpose: to help people understand finance and become more financially aware. He is now guiding Nand, who is working on a project for his company, to create a course on financial education. Their journey takes an interesting turn when Nilkanth accompanies Nand to his native village to attend his sister's wedding. Amid the wedding celebrations and village life, Nilkanth finds the perfect opportunity to teach Nand some important concepts related to shares and the stock market. Join Nilkanth and Nand on this journey as they simplify financial concepts through everyday conversations and real-life experiences. Walk with us on this journey and take a step towards becoming more financially aware. Dark clouds gathered over the village as the evening breeze carried the sound of temple bells. Nand sat on the veranda, staring at the red and green numbers flashing across his phone. His face was filled with confusion. How can one company be called expensive when its share price is only 80 rupees, while another company at 3,000 rupees is considered cheap? He muttered. Just then, Nilkanth returned from the temple, calm, smiling, and carrying nothing more than a cloth bag and years of investing wisdom. He noticed Nand's worried expression. Without saying a word, he sat beside him. "What troubles you, Nand?" he asked. Nand sighed. "Everyone says, study the fundamentals before investing, so I opened Screener." He turned the phone toward Nilkanth. "There are so many strange words. Market cap, PE, ROE, ROCE, book value, EBITDA. They all look important, but no one explains them in a way I can actually understand." He picked up a small seed lying on the veranda. "What do you see?" "A seed? And what do I see?" Nand shrugged. "A tree?" Nilkanth nodded. "Exactly. Most people see a stock. An investor sees a business. Just as this tiny seed can become a mighty banyan tree, every great company begins as a small idea. The secret is learning how to recognize the strength hidden within." He stood up and pointed toward the bustling weekly village market in the distance. "Come." "Where are we going?" "To the greatest classroom an investor can ever visit." Nand looked around in confusion. "The stock exchange?" Nilkanth laughed softly. "No. The marketplace." Seeing Nand's puzzled face, he continued. "Every shopkeeper here understands business better than many people who trade stocks every day. A vegetable seller knows cash flow. A jeweler understands intrinsic value. A banker gauges debt. A landlord explains return on assets. If you can understand this market, you can understand the stock market." As they stepped through the crowded entrance, the marketplace seemed to transform. Every shop held a lesson. Every merchant became a teacher. Every transaction revealed a secret of successful investing. Nilkanth smiled. "Today, Nand, you won't learn stock market terms. You'll learn how to think like an investor." Nilkanth pointed to 3 kingdoms: small village, growing town, giant city. Nilkanth, imagine every company is a kingdom. Market cap equals current share price times total shares. It tells how big the company is. Small cap, young kingdom. High risk, high reward. Mid cap, growing kingdom. Large cap, established empire. Consider the price of a mango. It fluctuates based on supply and demand. Sunny days or storms change the price. Similarly, a company's market value changes based on how the market perceives its future growth. The fruit seller said, "This mango reached 150 rupees this year, but once sold for 90 rupees. Nilkanth smiled. "That is 52-week high and low. It shows how much the stock has moved. Investors look for the high and low points of these price fluctuations. Recognizing these cycles helps in determining when a stock might be trading at an attractive price versus when it is overpriced." A milk shop earned $10 every year. People were ready to pay $200 for it. PE equals 200 divided by 10 equals 20. Nilkanth asked, "Would you pay 20 years of earnings today?" The PE ratio, or price to earnings, helps us understand how much investors are willing to pay for a company's earnings. A higher ratio might suggest high growth expectations, while a lower one could indicate a bargain. A factory closed tomorrow. It sells machines, buildings, furniture. After paying all loans, 500 crore rupees remains. That is the book value. Book value represents the net value of a company's assets after subtracting all its liabilities. It is essentially the what's left amount if a company were to sell everything it owns and pay off its debts. A farmer gives every family 5 kilograms rice every year in profit who has share in his land. Buying his small share of land costs 100 rupees. Dividend yield tells how much yearly income you receive. Dividend yield is the return an investor gets from a company's profits paid out as dividends. Think of it like the annual harvest you receive from your share of a field, a steady income from your investment. Nilkanth pointed to two factories. Both invested 100 crore rupees. Factory A earns 25 crore rupees. Factory B earns 12 crore rupees. Which owner uses money better? ROCE answers that. ROCE, or Return on Capital Employed, measures how efficiently a company uses its capital to generate profit. It is a key metric for understanding if a company is truly creating wealth or just burning through cash. A businessman invested 100 rupees. He earned 20 rupees. ROE equals 20%. ROE, or return on equity, shows how effectively management uses shareholders' money to generate returns. A strong ROE indicates that the company is effectively turning invested equity into growing profits. Every coin originally had 10 rupees written on it. Even if collectors pay 2,000 rupees later, its original denomination remains 10 rupees. That's face value. Face value is the nominal value of a share as stated on the company's certificate. While it differs from the market price, it is important for calculating dividends and understanding corporate actions. Company earns 1,000 rupees, has 100 shares. EPS equals $10. Each share earns $10. EPS, or earnings per share, shows how much of a company's profit is allocated to each individual share of stock. It is a vital indicator of a company's profitability on a per-share basis. One jeweler sold a diamond for 1 lakh rupees. Another expert valued it at 1.6 lakh rupees. Nilkanth said, "Market price is what people pay today. Intrinsic value is what it's actually worth." Finally, intrinsic value is the true calculated worth of a company, independent of its current market price. Smart investors focus on identifying when the intrinsic value is higher than the price they pay. Now, let's dive into the industry PE ratio. This metric helps compare a specific company's valuation to the average valuation of its peers within the same sector, providing context on whether it's trading at a premium or a discount. One sweet shop has PE 20, another PE 18. Entire sweet industry average equals 22. Comparing companies with industry helps identify expensive or cheap stocks. Next is the debt-to-equity ratio. It reveals how much a company relies on borrowed money compared to shareholder funds. A high ratio indicates higher financial risk, while a lower ratio generally points to a more stable balance sheet. A businessman owns 100 rupees, borrowed 30 rupees, debt by equity equal to 0.3. Another borrowed 300 rupees, debt by equity equal to 3. Nilkanth warned, too much debt becomes dangerous. The interest coverage ratio tells us a company's ability to pay interest on its outstanding debt from its operating profits. A higher number provides a safer cushion against financial downturns. A company earns 100 rupees. Interest payment, 10 rupees. Coverage, 10. It can comfortably repay loans. If coverage becomes 1 or below, danger begins. Median sales growth over 10 years is a powerful indicator of long-term business performance. It helps filter out temporary spikes or slumps to show the underlying, sustained growth trend of the company. Every year, the bakery sells more bread. Instead of looking at one lucky year, we observe the typical growth across 10 years. Consistent growth wins. Sales variation is also crucial. Consistent, steady growth is often viewed more favorably than volatile sales, which can make long-term planning and investment outcomes much harder to predict. Company A, 10%, 11%, 12%, 11%, 10%. Company B, 50%, negative 20%, 70%, negative 10%. Both average similar growth, but Company A is predictable. Sales variation measures consistency. Sales may rise, but profits can jump wildly. Stable profits show a stronger business. Profit variation, 10 years, means the changes or fluctuations in a company's profit over a period of 10 years. It shows whether the profit has increased, decreased, or varied from year to year. Nilkanth asked, if the owner believes in his business, would he buy more shares? Usually yes. Increasing promoter holding often signals confidence. Falling holding deserves investigation. Trade receivables are amounts of money that customers owe a business for goods or services purchased on credit. They represent money the company expects to receive from customers in the future. A grocery shop sold 1 lakh rupees goods. Customers promised, we'll pay later. That unpaid amount is trade receivables. Too much receivable means cash is stuck. Free cash flow, FCF, is the cash a company has left after paying its operating expenses and capital expenditures. After paying salaries, maintenance, new machines, money still remains. That leftover cash is free cash flow. Companies with strong FCF become stronger over time. PEG ratio, PEG ratio, compares a company's PE ratio with its expected earnings growth rate. It helps investors judge whether a stock's price is reasonable compared with its growth potential. Company A, PE equals 40, growth equals 40%, PEG equals 1. Company B, PE equals 40, growth equals 10%, PEG equals 4. PEG combines valuation with growth. Lower PEG often indicates better value relative to growth. Return on assets, ROA, shows how efficiently a company uses its assets to generate profit. A higher ROA generally indicates better efficiency in using the company's resources. 2 farms have land worth 100 crore rupees. Farm A earns 15 crore rupees. Farm B earns 6 crore rupees. ROE shows how efficiently assets generate profits. EV/EBITDA compares a company's total business value, enterprise value, with its operating earnings, EBITDA. It helps investors assess whether a company is relatively expensive or cheap compared with its earnings. Nilkanth pointed to 2 hotels. One has loans, cash, buildings. Another has none. Simply comparing prices isn't fair. EV considers the entire business value. EBITDA measures operating earnings. EV/EBITDA tells how expensive the whole business is. As the sun began to set, Nand smiled. Mama, earlier I thought investing meant watching stock prices. Nilkanth replied, No, Nand. A stock is not just a number on a screen. It is a real business. Every metric tells one chapter of its story. Nand closed the screener app and said, From today, I won't just buy stocks. I'll first understand their story. Thank you for watching Nilkanth explain important stock market terms to Nand in a simple way. We hope this journey helped you understand stocks and finance a little better. Keep learning, stay financially aware, and make informed financial decisions.